And good morning, market clubbers. Today is December 18th, and it is almost 11 o'clock, quarter to 11 here. And we are looking at an incredibly robust market today. Yesterday, we had this candle, which exceeded the day before's high, which is positive. And then today, we had a gap away. And we had a gap away showing a huge amount of energy. And the market right now is up 236 on the Dow, 66 on the composite to 47.10. The Dow is at 17,593. And the SPY is at 204.68. It's up 1.5% basically on all these markets. And what you're seeing, let's look into it a little bit differently, is you're seeing the Fed saying, hey, they're not going to print money or they're not going to raise interest rates for quite some time. We believe that they'll probably print money before they raise interest rates, but only time will tell on that. We're not here to predict. We're here to play the market as it comes. So let's look at the probabilities on what's going on. Here's what the chart is showing us today. This big gap away here, but it hasn't quite made the standard deviation. Look at all the energy that it lost, and 2 days of energy is not going to make up for all of these days lost unless this trend continues. And remember, we don't try to play the day by day. We try to play the trend, but we look at it day by day. So this trend, it bottomed here, and then we had that outside candle here, and then the gap away, and it's trying to make this standard deviation line, and it's actually right back to its 50-day average on many of the charts, including the New York Stock Exchange, which is what we look at. The Genius indicator is still negative, but it is rising, and the price action is rising. Now, we generally don't put a lot of emphasis on a second or third day move. We like IBD, Investors Business Daily, we look at the fourth day and hence move of a stock to really decide if it's a real trend in place. So my suspicion, and I don't know, this is a suspicion, is that we want to come back and fill this gap. And we're going to see what happens today and tomorrow. Today it's already in the lower third of its trading range. So we've had a lot of upside, and it's come back, and it's hanging in there. But there's a propensity for these gaps to get filled. So tomorrow it may get filled, maybe Monday, but we're looking at the market that way. There's going to be a lot of energy that's going to need to take to get through this next level and get the Genius indicator up a little bit higher for us to go yellow. So for right now, we are still red officially. I know it's frustrating to sit on the sidelines and not be able to partake in a 500-point move to the upside on the Dow over the last 2 days. But we don't try to catch the beginning of the trend or the end of the trend. We try to basically trade the middle of the trend, the middle 60%, where it's the least risk and the most likely that you have an actual trend in place. So right now we don't have a trend. We have a lot of noise. We have a reversal. And for us, if we want to talk macroeconomically, we don't believe that there is a full-on bull market going on right now. We think this is a trading market. It's channeling, and it's going up and down, and we think the propensity is to the downside. And here's why. For the last 6 years, the Fed has been printing money. And for the last 6 years, the market has continued to go up. The Fed says they're not printing money now, even though they are, but they're just not printing as much as they used to be. And so since they're not printing money, what's going to hold all these stocks up? Well, is it going to be the macroeconomics of Europe buying all of our products, which we don't really produce that many anymore? Probably not. Is it China? Well, China doesn't buy a lot of products from the United States, and what they do buy, they're having trouble with their economic situation. They're having a slowdown in China because, frankly, they're starting to get an inflationary economy because they've been producing all of our products and taking all of our money as we've been paying them to produce our TVs and phones, etc. So China is now not being a big buyer. So who are the buyers? Well, it's the emerging markets, which are still a small percentage of the pie. So yes, the economy is improving, but it's not improving at this level where we used to see in, say, the 80s and the late 90s, where we had lots of people buying things because of demographics. Right now, we just have a fake and artificially stimulated market, and we don't see that that's going to continue to carry us up in the near term. It may longer term, but in the near term, because we think that unless the Fed prints more money, which we think they will later, they're not going to be able to. We're not going to be able to use that extra money that we had for the last 6 years to hold up the prices. Hope that makes sense. But for right now, I know it's frustrating, but we're still in the red market, which means you could probably remain in cash. If you want to do some day trading and hedging, you could buy a undervalued long position and an overvalued short position, hedge them against each other, and hopefully make a little bit of money on the arbitrage in between. Other than that, may want to stay in cash and wait for the trend to appear, and we'll let you know as soon as it does. Happy trading, everybody.